In this week's update, high multiples take quite some time to wash out. We're set for market divergence like we've never seen before. And so how do we participate? My name's Garry Davis, and as always, this is general advice. And please remember to like and subscribe to the video. I regret that for those that watch this video regularly, I regret that there wasn't a video last week because it was just such a pivotal time. But I was having a week's R&R at a golf carnival down in Albany, and it just wasn't practical to get it done. But look, there shouldn't have been any surprises. I've been pointing to the signs since early December. The rotation away from growth stocks, the periodic little spikes in the VIX, the signs in the bond market. There were signs everywhere that we were getting a change in the markets. So there shouldn't have been any surprises. And I think it's now highly likely that we're in a cyclical bear market. Now, anything's possible, and who knows, the Fed might backtrack on policy and all of a sudden the market just shrugs it all off and goes up again. But I think that that likelihood is extremely small. So the overwhelming odds favour a cyclical bear market. But before you get concerned about that, we need to recognise what a cyclical bear market is. Now, in 2020, we had a cyclical bear market where the index went down about 38 or 40%, and it only lasted for 5 weeks. Now, that was because of a specific circumstance that caught the whole world, very much off guard. And so it was all washed through very quickly. But this time it's different. This time we've got a 3 to 4 decade reversal in interest rates. Now, the extent to which that happens remains to be seen, but I think there's no question that over time interest rates are going to start to track higher. So this time it's different. There is a more fundamental reason why we're having a cyclical bear market, and as a consequence, it's likely to last longer. It's likely to last 3 to 6 months as a minimum. Now, many stocks are going to keep falling, and they could keep declining for another 6 or 12 months. But a few, the lows might only be a few weeks away. So we are going to see this incredible divergence in performance between different stocks and different parts of the market. So how this cyclical bear market impacts you in particular depends very much on what you own. It really is so stock specific. So let's have a bit of a market perspective. I think you can, for most people, unless you are actually just owning the market or owning the equivalent of the index, you can pretty much forget what the index is doing in terms of taking your cues and formulating your strategy. And trying to predict the index is even a less worthwhile activity. The divergence between different parts of the market is going to be quite remarkable. As I said, some stocks are probably only a few weeks off their lows. Some might have even formed their lows, particularly in some of the major commodity stocks. But most stocks are going to decline for some time, so you need to be very careful. So what you must not do is hang on to conventional thinking and the old relationships, because all bets are off. This is a 4-decade reversal in interest rates at a time when debt is just astronomical compared to what it used to be. The stresses in the financial system are really going to get tested, and who knows how that's going to play out. So, don't get stuck on, I think this is going to happen because that's how it always works. You've just got to put all that aside. And what you must do, in my opinion, is to pursue guaranteed growth, because at the end of the day, that's what you want. That will make stock prices go up. Now, at the moment, some growth stocks are going down and going down hard because they're coming off very high multiples. But there'll be a point where that adjustment has run its course, and those stocks that are still growing will then be open to a significant reversal. But you need to enter well, and I'm going to go through an exercise in just a minute that shows you the difference between stocks that are on reasonable multiples and what their share prices are doing, and stocks that are on still high multiples and what their share price is doing. So you need to enter well, and that is very different for different stocks. And then, of course, you need the normal clear game plan to manage your portfolio. This is the sort of market where I think it requires two types of operation. One type of operation is that you buy high quality, high growth stocks at sensible valuations when the market is sold off, and you just look the other way for 6 or 12 months and you'll probably do pretty well. The other approach to the market is to basically trade it more short term, because I think this level of volatility and the incredible divergence between sectors is going to be quite extreme. So where is the guaranteed growth? I'm not going to go through all of these because I think everyone's got a pretty good idea now of what they are. Materials for decarbonisation, obviously a virtually guaranteed, I mean nothing's guaranteed, but in inverted commas, as good as guaranteed growth in decarbonisation materials. Managing and analysing data in the cloud is another area that I think is virtually guaranteed to continue to explode, and so on and so forth. There's a great many of them, and I think everyone is pretty aware what they are. So they're the fishing holes that you should be looking in. Now let's look at what dynamics are actually driving prices at the moment. What is it that's driving most prices down? And this is not an exhaustive list, but I think it gives you a reasonable idea. There is certainly the signs are clearly evident that institutions are what's called distributing stock. In other words, they're selling stock to people who still have the buy the dip mentality. And there's also some very higher levels of short selling that are going on as well. So not only are institutions liquidating their long positions, they're also actively shorting some of these stocks, which puts added downward pressure on the price. And that process is going to continue until the high multiples are reduced to something lower. And no one really knows what that something lower is at this point in time, because it depends a lot on sentiment, and cyclical bear markets finish when sentiment has been reset from bullish to bearish. That's usually where the lows are, where we get a capitulation, everybody gets so despondent that they chuck the towel in, a lot of people sell within a very concentrated period of time, and the sentiment is so bearish that there's really only one way for prices to go, and that's up. And that usually brings the conclusion to a cyclical bear market. So we don't know where that is, because it's not based on fundamentals or valuation. It's not even so much based on technicals. It's based on psychology. It's based on fear and capitulation and giving up. And we don't know where that point is until we get there. But what is important to recognise is that it's very easy to spot. But bottoms are pretty easy to spot in the market if you know what you're looking for. The second dynamic that's feeding into these price declines at the moment is the ETF spiral that had been going in the upwards direction for years and years and years, where it became a self-propelling mechanism. That is now reversing in part, and it's becoming a self-propelling mechanism to the downside. It doesn't follow logic. It is just the dynamic of the market. People are selling stocks, so that means that the stocks go down, the ETFs go down, the fund managers have to liquidate stocks, and so we get a spiral in the downward direction. Another dynamic that's playing out now, I'm sure, is that over the last few years in America, since the COVID crash, millions and millions, if not tens of millions of inexperienced people entered the market to try and trade, and they've not experienced a protracted period of losing money. And so how they respond is also an unknown. And then finally, in my list anyway, the algorithms are not programmed around the merits of a stock or even the valuation of a stock. A lot of the algorithms are really just, feeding off social media, for instance. A lot of the commentary on social media, they're feeding off all sorts of technical signals. And those things are just going to play out until they exhaust themselves. So there's a lot of dynamics. The point I want to make here is that there is a lot of dynamics that lead to illogical price declines that have got nothing to do with merit or valuation. So if you're sitting there thinking this stock can't go down any further because of X, Y, Z, then you want to think again, because once these dynamics start to play out, the price can go a lot further down than what you would think. Now, let me show you some examples to illustrate this very substantial divergence. Now, this is a company which is a bit of a favourite of mine, but these are not recommendations. These are stocks to make the point about the divergence in performance. So Blackstone is one of the world's largest asset managers, market cap around $80 billion. Now, Q4 earnings, which came out during the week, you can see we had quite a strong reversal here a few days ago. And despite the market, doing pretty poorly in the last week, Blackstone has done extremely well. So the quarterly earnings came in at $1.71 versus an expected $1.34. That was a 27% surprise to the upside, more than what Wall Street was expecting. Now, if we look at the earnings per share growth, compound average growth from 2018 to 2023, so that's several years of history and a couple of years of looking forward, then we're looking at compound annual earnings growth of 22% per annum. Now, the earnings for 2022, which is what the stock is pretty much being priced on now, is $5.10. That puts the stock on a PE multiple of 24 times. Now, these are just very broad brush relationships, but just to give you a sense. So we're looking at the stock trading on 24 times this year's earnings and 21 times next year's earnings. And that relates to 22% compound annual growth rate in earnings. So the valuation of Blackstone is absolutely fine. So there is no reason for this stock to be sold down aggressively based on high multiples, because the high multiples just don't exist. And so when they came out with a result that beat expectations, the stock got rewarded. It had touched a low down here, just over $100, and closed the week at nearly $125. So it was up nearly 25% from its lows in just a few days. So that's how the market will treat stocks that are not trading on a high multiple. And this is just one of numerous large caps where the multiples are not high. But there are a lot of large cap growth stocks where the multiples are high. But just to demonstrate that this is not a one-off, let's look at Microsoft, that I like to look at a lot. Market cap, $2,200 billion or $2.2 trillion. They beat expectations by 8%, $2.48 versus $2.29 expected. So this is just in the last couple of days. Their compound annual growth rate from 2019 to 2023 was 23% per annum. This year, that corresponds to a PE of 32, and next year, a PE of 27. For 23% compound annual growth rate, this is not a high multiple. This is absolutely fine. There is no reason for the price of Microsoft to fall heavily. Now, it might in a panic, because people just panic and you get a logical outcome. So I'm not saying the price of Microsoft can't go down, because it could well do, but it doesn't need to. But there are many stocks where it needs to, because we're now in a different environment. We're now in an environment where everyone expects interest rates to progressively rise for many years to come. Let's look at Apple, another one that came out with a result on Thursday night, Friday morning. Market cap $2.8 trillion, Q4 earnings came in at $2.10 versus $1.89, an 11% surprise. That's an incredibly good result, because these stocks are covered by just dozens and dozens of Wall Street analysts. They're all over them every day of the week. So to come out with an 11% surprise is a pretty good effort. Their compound earnings growth rate from 2019 to 2023 comes in at 25% per annum. They're trading on this year's 28 times and next year 26 times. So again, valuation absolutely fine. There is no reason for the stock price to fall. And you can see what the market did with this. Now, the price of Apple had already been proving to be very resilient before the earnings announcement. It was still comfortably above the 200-day moving average, which was still rising. So Wall Street knew that Apple was going to come out with some good earnings. But nevertheless, it had been sold off a little bit, and this was now a sharp reply. And you can see on pretty good volume. Visa. Market cap that's not correct on that one. I should have changed that. I'm not sure. I'll just erase that. I'm not sure what the market cap on Visa is. I think it's something around the 250-300 billion mark. Okay, now Visa, their earnings came in at $1.81 versus $1.69, a 7% earnings surprise. 14% is the long-term earnings growth rate. That puts them on this year's earnings multiple of 29 and next year of 27. This is not as an attractive set of fundamental numbers, valuation numbers, compared to the previous stocks, yet look at what the market did. It rewarded Visa incredibly well. So there's just no telling sometimes how the market might respond. So they're all the larger cap stocks that really don't need to see a significant contraction in multiples. But let's look at some others that you could argue perhaps do. This is Tesla. Now, whether you're positive or negative on Tesla, it tends to be a very polarizing sort of stock. The market cap is $850 billion. Their quarterly earnings were a 22% surprise. And yes, Tesla does make money these days. 205 versus 168. Their long-term earnings per share growth rate from 2020 to 2023 is 75% per annum. Now, okay, that's coming off a lower base compared to some of the other stocks. So you would expect this number to be higher, but nevertheless, it's a pretty healthy growth rate. But if we look at their earnings per share, their earnings per share for 2022, it comes in at $10.40 and then $12.45 next year. Corresponds to 81 times and then 68 times. Now, compared to their growth rate, it's not unreasonable. However, high multiple stocks are in the process of being sold down. And you can see that despite coming in with a 22% surprise, look at how the market treated Tesla. Blackstone, look at what it did to an earnings beat. Microsoft, Apple, market voted very positively. Tesla, not so. So we are in an environment where high multiple stocks are being sold down. There's just no question about it. It was a much worse market reaction despite a bigger surprise and a much higher growth rate. And it's about the multiple, and you've just got to recognize that this is the wrong time for high multiple stocks. So you've got to acknowledge that. The tide's against you. Go and fish somewhere else for the rest of the majority of 2022. If you want to hold on to your old thinking, which is, I love buying stocks like Tesla or whatever, you just got to recognize that the tide is against you. And, and that's the single most important message I want to get across today. Now, the other thing that's happening in the market is, and this is ARKK, which is Cathy Wood's stable of ETFs on concept stocks, on ultra high growth stocks for the future, many of which not only don't have profit, many of them don't even have revenues at this stage. Now, the market previously had a strong appetite for high revenue growth but no earnings. And you can see that from the COVID crash in 2020, the price of ARKK went from 40 to 160, so a 400% gain, and was an absolute market darling, and everyone was piling into it. The market had a real appetite for that sort of stock. Now it doesn't. And we've now gone from 160 and we're now back to the mid-60s. So it's just simply not advisable to pursue these type of stocks. No matter what you think about the story, the tide is against you. And look at the strength of this downtrend and look at the volume associated with it. This is massive scale liquidation happening, and I can't tell you where the bottom is. And on this, you can't say that the bottom is in. Now, one final thing that I want to point to, let's look at Microsoft. So to put all this in context about the opportunities, where might the price of Microsoft go? Because at the end of the day, that's what's important. All these contemplations about valuation and multiples are interesting, but it's how do we make money out of this? So the earnings per share likely for Microsoft at the moment, and the way they've been going, and the fact that they keep surprising to the upside on earnings and have been doing it for years, the earnings per share conservatively is likely to be $11.50 in 2023, and by the end of this year, that is what the market will be pricing in. So it's likely that the financial year 23 multiple is likely to be somewhere in the 30 to 35 times area. Now let's look at where Microsoft is at the moment. Current year, 32. We've already had some selling, so it's possible that quite a bit of the selling's already been done. The multiple contraction has happened. 32 times this current year, 27 times next year. So it's not unreasonable to expect that once this has reset and growth stocks get back into a more positive sentiment again, that multiples of 30 to 35 times would be fair enough. And if the earnings growth continues to come through in the low 20% area, then that would be quite reasonable from a long-term perspective. And I remember years ago reading where Warren Buffett said that PEG ratios in quality stocks, anything up to 1.5 or even 1.8 times is acceptable. So if the growth rate is 22%, then on Buffett's yardstick, then you can pay multiples into the low 30s and it's still reasonable. Now, those multiples of 30 to 35 correspond to a share price of 345 to 400 by the end of this year. We're currently at 308. So you can see that there is some significant upside even from where we sit now. And Microsoft has just bounced quite nicely because of the earnings result. Now, if the market crashes in a bit of a panic washout, which is possible, then $260 on Microsoft, somewhere down here, is quite possible. And if you could get into Microsoft on a sell-off, then it would be an absolute steal, because I think there's a very high likelihood that this is where we're going, somewhere between 345 and 400 by the end of this year. You know, nothing marvelous or outlandish needs to happen for Microsoft to be trading at those levels. So the question is, and this is the key question, how are you going to capture this highly probable and significant gain with limited risk without stretching your psychology? How will you stay on top of the market sentiment so that you can pull the trigger when the time comes? And how will you manage the volatility? So the purpose of this whole exercise is to paint the picture on several things. Firstly, the real quality growth stocks, their bottoms may not be very far away, and so good buying opportunities could come up at any time. And secondly, in a panic situation, there is very significant potential upside in these stocks. You just need to make sure you've got your list clear and that you're in a strong psychological position when the time comes to actually pull the trigger. And most people aren't, because they just they join in the crowd, they get fearful about what's happening, they accept everything the media is telling us, that the stock market's going to go down for years, and all these sort of things, and they're just too frightened to pull the trigger. And that's normal. That happens all the time. So, that is the real question. All right, let's move on. The American market, the S&P actually ended up gaining 0.7% for the week. We had such a good finish on Friday night. That was an overall gain. And strong earnings are still being rewarded, as we saw with those stocks. But when we look at the index, there's been plenty of technical damage done. The 200-day moving average has broken, and we'll have a look at how that may play out at the index level. Not that that's all that critical because of this massive divergence that's going on underneath. Now, the US dollar sharply higher to 97.22. The 10-year yield was also higher to 1.86, so it's certainly getting up there now. The VIX peaked at 38, finished at 27.7. So a pretty volatile week in the States. Let's have a look at what it looked like on the charts. So we've had a break of the 200-day moving average. That hadn't happened since the COVID crash, as you can see. We've now rallied back. We had a big intraday reversal on Monday off lows. We got right down here to a technical support level, one would have to say. And so probably no real surprise that the market bounced. So it bounced right off that technical support. But then there was no follow through. It didn't really bounce. And the next 3 days were neutral to negative. And then we got a big bounce on Friday because of some better than expected inflation data. And so the market sort of seized on that. But look, when you've got a decline, we've gone from 4,800, we got down to 42 something, you always get counter-cyclical bounces. And it's almost certain that we will get a sucker rally. In other words, my thesis is that we have got another leg coming to the downside. So we will have some up to a level, and I'm not saying that this is the low. And then I'm very sure that we'll then see at the index level another decline. So, don't get caught into this rally. Now, the one thing that I am unclear about is there further selling before we get the bounce, or will the bounce just come now? I think either way it's a bit academic, but just be very, very careful about going into this rally thinking that it's all done and dusted, because it's highly likely that we've still got this leg to go. However, as I said earlier, the Microsofts, the Apples, the Blackstones, they might have already bottomed. So don't think that just because the index is going to do this, and I'm targeting somewhere around the 3,800 level, I think is likely, as I covered, I think, the week before last. Don't just take your cues from the overall index. Now, if we look at the Nasdaq, so just keep that picture in mind of the S&P. So the 200-day moving average is still rising. The index is a little bit below it, but has broken it. But let's look at the Nasdaq. So we're now further down on the Nasdaq. We're well below the 200-day. Our shorter-term moving averages have rolled over to a greater extent. So we are seeing more significant selling in the growth area. Let's look at small caps. This is the Russell. We've now clearly broken down out of that sideways channel. All the moving averages now have rolled over, and clearly small caps are being actively sold. If we look at, let's narrow that in a little bit more. So rather than general small caps, let's look at the mid-cap Russell growth stocks. And again, you can see very, very sharp selling. All the moving averages have rolled over very significantly. The volumes are up. There's just no question about what's going on in the market. And we've only got the larger cap stocks and some of the defensive sectors that are holding the S&P up. And normally what would happen in a cyclical bear market is that they're the last ones to let go. And eventually we will see some heavier falls in the index level because those large caps start to participate in the selling as well. Now, let's look at some of the spread charts that are important. Okay, so this is the Nasdaq 100 against the S&P. So you can see the Nasdaq clearly underperforming the S&P at the moment, and that's because growth stocks are being sold. This is the small cap Dow Jones small cap growth stocks versus value stocks. Again, the line is dropping very, very quickly. So the exodus out of growth stocks, small cap growth stocks, is really starting to gain traction now. This is the 1000 Russell 1000 growth stocks. So this is more the larger end of the market. Now we had a nice reversal on Friday, but it's been a meteoric drop. So that trend is still clearly to the downside. And this is consumer discretionary versus consumer staples. We've now broken a key support level, and again we're just clearly in decline. So there's no argument about what we've got. The only question is how long it's going to last, and what stocks are going to do best in that environment. Turning now to the currencies, there's the US dollar really showing strength again now, thanks to the direction the Fed's taking with winding back their bond buying, raising interest rates, which could happen in March, and so that's been strong for the US dollar. That, of course, has pushed down the Australian dollar, and we're now at the lowest level in 18 months. So you've got to go all the way back here to the middle of 2020, and you can see that the Australian dollar is clearly in downtrend. The moving average has rolled over. The price is consistently underneath it, can't break through it, and so therefore, I think levels down in the mid 67s are likely, and possibly. Possibly even as far down as 60 if things get really nasty. Not saying that'll happen, but that's possible. Okay, let's move on to the Australian market. Our dollar 69.37, and they're the levels that I think are possible. Certainly 67.5 looks likely. Now, our index was down 2.6% for the week. One would assume that we'll probably get some buying on Monday, but look, everything was sold last week in Australia, but some parts did better than others. Stocks like BHP and Rio did really well, so the materials sector was good, and I think there's little doubt that we've got a commodities super cycle either underway now or looming in the next couple of years, because that often goes with inflation anyway, the late cycle part of the economic cycle. And then we've also got this whole decarbonisation theme as well, which is really spurring along a lot of commodity demand and a lot of commodity prices. So that's where the Australian market is heading. The large cap stocks, the large cap commodity stocks did really well. The small cap commodity stocks got beaten up, but that's normal. That's what happens in this sort of market. Small caps get sold off first, they recover last, and the bigger stocks are the ones that show the greater resilience. So let's take a look at some of the action here. So if we look at materials, well, let me first of all look at the overall index. So the overall index, we've broken down, and we've had quite a sharp sell from that key support level around 71.70. And as you can see, nice rally on Friday, but still plenty of work to do, and I suspect that our index might just rally back to this breakdown level and then fall away again. But look at where the price is in relation to the 200-day moving average. Let's look at materials. Materials have been trading above the 200-day moving average, and if we look at stocks like BHP, for instance, you can see BHP did really well. Now that action on Friday is almost certainly related to the fact that BHP's come back home to Australia, but it's still been showing a great deal of positivity. The 200-day moving average is still rising. The price is still comfortably above the 200-day moving average. So these are the areas that are showing greater strength in the Australian market. Healthcare has been absolutely murdered in Australia. So this is the high multiple contraction going on. CSL, ResMed, Cochlear, great stocks, but they've just been trading on really, really high multiples for years and years, even decades, while we were in an interest rate declining environment. The market is now saying we're just not going to pay 45 times earnings for CSL anymore. We're only going to pay something less. And so we're getting this material multiple contraction. There's nothing wrong with the companies. It's just this is multiple contraction really kicking in. If we look at energy has held up reasonably well, but I would still be putting my money on the BHPs and the Rios rather than the Woodsides. Finance has not done too badly. It's down a bit. Finance will always prove to be reasonably resilient, but it's certainly not the area where I would be looking to have the majority of my funds, as opposed to a lot of investors. And this is small caps. So small caps really did have a hard time of it last week. We had heavy selling for 4 days in the Australian market in small caps when it broke those levels. So that's the situation there. Bitcoin continues to be sold down. We're now clearly in downtrend, so this is all part of the risk-off. The risk-off sentiment, and Bitcoin finished at 37.74. If we look at gold on a daily basis, back down again once the Fed comments came out, back down quite sharply. We're up around the 1850 mark and closed down under 1800, and it's just going sideways when you look at the weekly chart. Silver, really no different. So not a lot of change in those ones. And if we look at the gold stock indices, we're right back down the bottom again in GDX and GDXJ. So gold stocks, the 200-day moving average is pointing down, the price is below it. Gold stocks are very problematic at the moment. So just whizzing through that, gold down by 43. I think it's higher rates that are scaring the bulls, and I think normally inflation is something that would get gold going. It just doesn't seem to be able to do it at the moment, and maybe the only thing that's going to get gold going is is a war or something in Ukraine or Taiwan. Maybe that's the only thing that's going to get gold going. It's been very disappointing. But if you look at gold, given the Australian dollar has come off so much, if you look at gold in Australian dollars, we're now down to we're up to $2,550. So this is really profitable territory, because the better Australian gold producers have got all-in sustaining costs somewhere around $1,300 or $1,400 an ounce. So they're making northwards of 80% profit margin, 80-90% profit margin. So the Australian gold stocks are extremely profitable. It's just sentiment towards them is just lousy. So they're back to struggling again. And for me, the sector just remains a bit of a tease, certainly in the US. In Australia, there are certainly some good things happening. There are some stocks, gold stocks, that I think could get re-rated upwards, that are coming into production, that are looking quite cheap. But in general, as a sector, very, very difficult. Turning to other commodities, copper was down a little. to 437, which is really just currency related. Nickel fell to 1029, and that was a lot about a shipment out of Indonesia for nickel, what's called nickel matte, which is a potential new technology. It's not really that proven at scale yet, but the new technology is around producing nickel from laterite ores, which are far more available than sulfide nickel ores, but previously were much more expensive to process. But this new technology could make the processing much more viable, and if that's the case, then a huge amount of nickel would come onto the market that previously wasn't, and so it could take significant share from nickel sulfides. Now, that's probably years away from the reality if the technology can be proven. So there's a long way to go on that, but nevertheless, the market, does what it always does, and it has this sharp reaction. I think the price of nickel fell about 6 or 7% on that news. West Texas Intermediate crude shot up to 87, so it's looking amazingly strong. The US energy market has got a rocket under it, and has done extremely well. But local energy stocks, not so much, and we saw that with XCJ, just not really firing off all that strongly. There's the spot copper chart, so not a lot of change there. Copper remaining pretty stable. There's our spot nickel chart. So we did come off from about 1075 and finished down in the low 10s on that news. But at this point in time, on what we know, the demand outlook for nickel is still very strong, and this is good part of the reason why, and that's warehouse levels are getting down near 5-year lows. So that's what's feeding into the nickel price. Wrapping things up, there will be a bounce. There always is. In 1987 to 2000, 2008, there's always a bounce before the main decline. So I think it's highly likely there's going to be a sucker rally, whether it started on Friday night or whether it doesn't start for another few weeks. I have no opinion on that. And frankly, I don't want to have an opinion on that because I want to keep my mind completely open to what the price action is telling me. Now, all stocks are going to have headwinds until this correction is complete. And this correction might take several more months to play out. My personal view is that a likely timing would be when the inflation data starts to look better on a comparative year-on-year basis. And that is likely to start to kick in April, May, June, because the numbers that will be dropping off in America will be the low numbers will be dropping off in the calculation, and the CPI comparisons will be against higher numbers. So I think the inflationary outlook and the sentiment around the market will improve in 2, 3, 4 months. The correction will play out, I think, before we get to that point, because markets are always ahead of the data. So it just sort of feels about right to me that that the correction could have another couple of months to run with, and we probably haven't seen the significant declines yet. But the important thing is that we've got some terrific stocks that can offer us outstanding returns with limited risk if we can get our timing right on the entry. And that's what I'm all over when it comes to the memberships that I've got. Keeping members up to date with that. Now, portfolio analyst last week was quite a good session, or the week before, I should say, because there wasn't one last week. It was dealing with sharp corrections. It was what to do if you're still uncomfortably exposed. The subject of green, iron and steel came up, and also large cap growth stocks to watch. So it was quite a good session. All right, that's it for this week. I'm sure it'll be volatile and highly fascinating again. This is a market where you want to be really, really careful. Be clear about what you're doing. Be patient. Don't get caught in trying to trade every little rally, because it's going to be hard to do that. So we'll see how the week pans out. I'll be back with you next Sunday. There's more information on the website. There's my email address. And look forward to a fascinating week. Cheers.